We've got very positive news. Wall Street starts to buy more and more Bitcoin. The inflows into the Bitcoin ETF start to accelerate. Let's have a look at how much impact this has on the price. Let's try to figure out how much longer those inflows might last. Now here's the data since launch of the ETF. This is the inflows measured in BTC. And initially we have seen how the outflows from the Grayscale Bitcoin Trust, so that's over here in red, tended to offset the inflows to those new vehicles. However, it seems like now, in the recent past, we don't see that many more outflows from Grayscale. We only see net inflows into the new vehicles. And so that's then how that looks like over time. This is the assets under management in those Bitcoin ETFs measured in US dollars. And this is very close to an all-time high. 65 billion worth of Bitcoin is now in those ETFs. Now there is a bit of ups and downs here, and that's because the Bitcoin price itself fluctuates. So when we look at the assets under management measured in Bitcoin, this tends to go up quite consistently. And so because the selling of the Grayscale Bitcoin Trust is pretty much at zero, and because there are inflows in those other ETFs, the dominance of Grayscale tends to decline over time. So this is the balance in those Bitcoin ETFs. Again, Grayscale is in red, and IBIT, which is launched by BlackRock, is now the largest of the ETFs with 41% market share, followed by Fidelity with 19%. Now here's an interesting question. Do we see some kind of a connection between the Wall Street demand, between the ETF demand and the Bitcoin price? As in, is Wall Street buying when Bitcoin is low, and is it selling when Bitcoin is high? Or are we simply just seeing allocation towards Bitcoin, some kind of dollar cost averaging? Let's have a look at the in and outflows measured in Bitcoin and measured in US dollars. So here we see the in and outflows in Bitcoin, and it looks like this tends to slow down somewhat. So we had a lot of demand initially. Now we seem to have a bit less demand. But when we look at this measured in US dollars, this looks a bit more flat. Now what does this indicate? I believe it indicates that we simply see allocation towards Bitcoin, not necessarily active speculation. Wall Street doesn't seem to think in terms of how many Bitcoin do I want to hold or how much of all of Bitcoin's supply do I want to hold. Wall Street seems to think in terms of portfolio allocations that's measured in US dollars. So it's the same kind of US dollar transactions independent of the Bitcoin price. In other words, if Bitcoin's price was to suddenly double, then the supply absorption by the Bitcoin ETF would get cut in half. Again, assuming constant dollar inflows. And since the inflows seem to be more stable measured in dollars than measured in BTC, I believe that's a reasonable assumption. Now, psychological anchor points are pretty important, as in, when we buy an asset, we always look at the current price relative to the price at what we purchased it at. In other words, if the market is in aggregate in profit, the market in aggregate might rather sell. When the market in aggregate is in losses, the market might rather continue to hold. So looking at the average cost basis of a market makes a lot of sense. And what we've got over here is the average ETF cost basis. So for Wall Street, is Wall Street currently in profit or in losses? And it seems like currently we are hovering around that cost basis, which is currently at 60.5K. Now here's a chart I slightly prefer to the average cost basis of the ETF, because still the ETF doesn't hold the majority of Bitcoin. I like to look at the realized price of all the coins that have ever moved, not just of the ETF tokens. And when we look at that, again, we tend to move above and below every now and then. And whenever we are below the average cost basis of the market, it's a very good time to buy. It doesn't happen too often. It happens every 4 years or so. Currently, we are at 33,000 roughly in the realized price. Last time we were below that realized price was in summer and autumn of 2022, when FTX and Celsius collapsed. So we might have to wait another 2 years if history repeats itself to get out those hyper cheap prices again. Now at the moment, only 5% of all of Bitcoin's supply is held by the ETFs. Why are we looking at those 5% and not at the 95 other percent? The reason is because a lot of that 5% is pretty liquid. It does determine, at least short term, the price of Bitcoin quite a bit. Because even though there isn't that much held, relatively speaking, when we look at the Bitcoin price performance here at the y-axis relative to the ETF flows here on the x-axis, we do see quite a clear correlation. 5% of Bitcoin supply obviously does not explain all of the price movements, so those dots are not on a linear line. But they are somewhat correlated, right? We can see that there is a connection. It's not really surprising that 5% of the market can move the price that much simply because those 5% are hyper liquid. Now the inflows that we have seen in the last 2 weeks were definitely outsized, and if we can continue those inflows, that would be super bullish for Bitcoin. In the last 2 weeks we have seen a supply absorption annualized by more than 10%. In other words, we would go from 5% of ETF holdings all the way to 15% of ETF holdings if the last 2 weeks were representative of what's going to come in the next 52 weeks. That's of course not very realistic, but still it shows that at the moment there is a lot of demand without all of those grayscale outflows. It first looked like the Bitcoin ETF demand slowed down a lot, but now it's accelerating again. Now there are two price drivers of Bitcoin. We've got on the one hand the short-term speculation or the speculative money that tries to ride the waves. And then on the other hand, we've got the long-term dollar cost averagers that simply just keep their wealth in Bitcoin. And the speculative money is of course what creates those massive ups and downs, those regular 80% drops in the Bitcoin price. What we see here at the bottom is the percent of Bitcoin that's held for less than 6 months. And it goes in waves quite a bit. But besides those waves, we've got of course the long-term upwards trend. And that's caused by those long-term accumulators. What we see here at the bottom now is the percent of Bitcoin that hasn't moved for the last 5 years. That's currently at roughly 30%. Let's take a price point over here where we were neither super expensive nor super cheap, so roughly at 7,000 US dollars. At the time we had roughly 18% of Bitcoin supply in those long-term holder hands. Now we are at maybe 30%. So we went up by 12 percentage points. Those 12 percentage points caused an increase in Bitcoin's price by 10x. So a lot of Bitcoin isn't liquid, the order books are somewhat thin, and so just a delta in long-term holding of 12 percentage points can create such a massive price impact. And that's why those 10 percentage points per annum for the Bitcoin ETF are such positive news. The problem of course is that those 10% won't go on forever. There is obviously fluctuation in the demand, and the last 14 days aren't representative. But the second effect is also if Bitcoin was to do another 10x in price, since we've seen that the inflows are rather US dollar driven, not Bitcoin number driven. The price was to go 10x, then the demand absorption would go down from 10% per annum to only 1% per annum. The question then is if we see some kind of FOMO across Wall Street as well. So if Bitcoin was to move from 60k to 600k, is then Wall Street going to buy up even more? Will then the demand actually grow with the growing price? We don't see that effect in the data yet, but who knows what happens in those extreme scenarios. Now let's assume you're already massively exposed to Bitcoin. You've already got a lot of your money in Bitcoin, and at some point you're considering to rather take some chips off the table. What could be the earliest point to potentially sell? Where could we see our first resistance? One possible way is to simply just use curved lines. So this is no logarithmic regression. This is simply just drawing random lines on charts. But we do see how the tops align quite nicely. We also see how the bottoms align quite nicely. And we look at that trading range. And yes, I know that the slopes of those lines are converging, but if we look at that trading range, we get to a potential resistance at 117k roughly. Now, I personally approach this slightly differently. I don't look at lines like this. I'm not really that interested in the price charts. What I look at is on-chain metrics. I want to see when are the long-term holders selling. And so whenever the value days destroyed metric turns red, that's when I take chips off the table. I've done this several times in the past. I sold a lot when Bitcoin was at around 40k. I also sold a lot in the middle of March of this year. To be more precise, I sold 1 day after the all-time high. I'm now back in the market. I bought back in for a lower price, but I did take profit on the 14th of March. And here's the proof. That's the video in the premium membership, premium update, 14th of March. I sold some Bitcoin. And again, the reason was simply because the long-term holders, they were selling. And I will continue to use that metric. Whenever this turns red, I get cautious. We are very far away from that right now. And so if you want to know when I buy and sell, if you want to get my view on the market, if you want to know what kind of altcoins I buy, feel free to check out Premium. There's various chat groups in Premium as well. There's more than 100 tutorial videos, and it's currently priced at $125 per month. There's also a 1-week money back guarantee. So in case you don't like what you see, simply message me within the first week and I will refund you 100%. Looking forward to seeing you in the next videos. Looking forward to also seeing you in Premium. Cheers.